Imagine you wake up one morning, make your coffee, sit down at your kitchen table, and realize you don't owe anyone anything for the roof over your head. No bank, no mortgage payment, no interest quietly draining your account every single month. Just yours. Now here's the strange part. Most people think that moment would feel like winning the lottery, and financially speaking, it kind of is. But what actually happens to people after they pay off their home is far more interesting and far more psychological than most financial advice will ever tell you. Because it's not just about the money you save. It's about how your entire relationship with money, risk, and life decisions completely shifts. It's like someone quietly removed a weight from your chest that you'd been carrying so long, you forgot it was even there. So today we're going to talk about why paying off your house isn't just a financial milestone. It's a psychological transformation, and understanding it might completely change how you think about debt, wealth, and what financial freedom actually feels like. Here's the belief most people hold about home ownership and debt. They think a mortgage is just normal. It's the responsible adult thing to do. You buy a house, you get a 30-year mortgage, you make payments every month like clockwork, and somewhere in the background, you're building equity. That's the plan. That's what everyone does. And for the most part, people accept the mortgage as a permanent fixture of adult life, like taxes or traffic. Something you just live with. In fact, a lot of financial advice out there actually tells you not to pay off your mortgage early. The argument sounds smart on paper. Your mortgage interest rate is 4%. The stock market returns 8% on average, so invest the difference. You'll come out ahead mathematically. And honestly, in a spreadsheet, that math works. But here's what the spreadsheet completely misses. Human beings are not spreadsheets. We don't make decisions based purely on optimized numbers. We make decisions based on how we feel. Based on fear, comfort, stress, and perceived safety. And this is where the psychology of paying off a house gets really fascinating. Let's start with something called your baseline financial anxiety. Think of it like background noise. Even when things are going well, you have a stable job, some savings, a decent life, there's this low hum of financial pressure that never fully goes away. And for most homeowners, the single loudest source of that hum is the mortgage. Because a mortgage isn't just a payment, it's an obligation. It's a number that has to be met every single month, no matter what happens. Lose your job, still owe it. Get sick, still owe it. Market crashes, still owe it. Psychologists call this kind of recurring financial pressure a fixed commitment threat. It's not just that the payment exists, it's that failing to make it has catastrophic consequences. You could lose your home, and your brain, even when everything is fine, is quietly running that risk calculation in the background, every month, for 30 years. Now imagine that disappears. Not reduced, not refinanced, gone. Suddenly, your baseline financial anxiety drops dramatically. And this isn't just a feeling. It changes your actual decision-making. When people feel less financially threatened, they take smarter, more calculated risks. They think longer term. They become more generous. They make better career decisions. This is the first thing that changes after paying off your house. Your mind changes, and your mind controls everything else. Let's talk about what happens to your cash flow next, because this part is deeply underrated. The average mortgage payment in many countries represents somewhere between 25% and 40% of a household's monthly take-home income. That's not a small number. That is the single largest line item in most family budgets. Every month, year after year, for decades. When that payment disappears, something remarkable happens. It's not that you suddenly feel rich, it's that you feel flexible. Think of it this way. Imagine you've been carrying a backpack full of rocks every day for years. You're used to it. You've built your whole routine around it. Then one day someone removes the backpack. You don't just feel lighter, you suddenly realize how many things you could do that the backpack was quietly preventing. That's what happens to people's financial lives after mortgage payoff. The money that was locked into the bank's pocket every month is now yours to direct. And the psychological shift that comes with directing your money, rather than just servicing a debt, is profound. Some people invested aggressively. Some fund their children's education. Some start a business they'd been dreaming about for years but never felt safe enough to try. Some simply save it, knowing that their safety net is now vastly stronger than it's ever been. The point is that the options open up, and having options is one of the most underrated components of real wealth. Here's where we get into the deeper idea that most people miss entirely. There's a concept in psychology called loss aversion. It was studied extensively by two brilliant researchers, Daniel Kahneman and Amos Tversky. The core finding is simple but powerful. Losing something feels about twice as painful as gaining the equivalent thing feels good. In other words, the fear of losing $100 hurts more than the joy of gaining $100. Now apply that to homeownership. When you carry a mortgage, somewhere deep in your psychology, you are perpetually at risk of loss. The home isn't fully yours. Miss enough payments, and it's gone. This loss aversion sits in the background of every financial decision you make. It makes you more conservative in your investments, more hesitant to change jobs, more afraid to take the leap on that side business or career pivot that could change your life. But when the house is paid off, that loss aversion shifts. You still have it. Everyone does. But now it's working for you instead of against you, because now you have a significant, tangible, fully owned asset. And instead of fearing what you might lose, you begin to think about what you might build. This psychological pivot, from scarcity protection to abundance building, is why so many people report that paying off their home fundamentally changed how they think about wealth. It's not that they suddenly have more money in the bank. It's that they finally feel safe enough to think bigger. There's another insight worth sitting with here, and it has to do with what economists call the sleep at night factor. You cannot measure peace of mind on a spreadsheet. You cannot calculate the value of knowing that no matter what happens in the economy, in the stock market, or at your job, you will always have a home. That psychological safety is worth something real, something that interest rate comparisons and investment return models will never capture. And this matters enormously during crises. Think about what happens during economic downturns. People lose jobs, markets fall, fear spikes. In those moments, people with mortgages are in a fundamentally different psychological position than people without them. The homeowner with a paid-off house can afford to be patient. They can weather the storm. They can even take advantage of the downturn, buying investments at lower prices while others are panic selling to cover their obligations. Owning your home outright doesn't just make you feel safer. In a crisis, it literally is safer. And that safety creates opportunity, which is the real secret of long-term wealth building. So what do you actually do with all of this? First, stop thinking about your mortgage purely as a math problem. Yes, the numbers matter, but so does your psychology, your stress level, your risk tolerance, and the decisions you make when you feel financially secure versus financially threatened. Second, if you're in a position where you can make extra principal payments on your mortgage, even small ones, start thinking about it differently. You're not just reducing debt. You're buying back your own financial freedom, one payment at a time. You're reducing your baseline anxiety. You're shortening the length of time you're exposed to that fixed commitment threat. Third, and this is crucial, understand that the greatest benefit of paying off your home isn't the interest you save. It's the person you become afterward, the risks you're willing to take, the investments you feel comfortable making, the career decisions you're finally free to explore, the version of yourself that shows up when the biggest financial weight you've ever carried is gone. People who pay off their homes don't just have more money. They tend to make better decisions with the money they have. And that compounding effect of better decisions made over many years is worth far more than any spreadsheet calculation could ever show. Here's the thought I want to leave you with. We talk about financial freedom like it's some distant destination, a number in an account, a retirement date circled on a calendar. But for millions of people, the first real taste of financial freedom doesn't come from a stock portfolio or a business exit. It comes from a quiet Tuesday morning when they make their last mortgage payment, hang up the phone, and just sit with the silence of owning something completely. No payment due, no bank holding a claim, just a home that is fully, completely, irreversibly theirs. And in that moment, something shifts, not just in their bank account, in their brain, in the way they see risk, possibility, and what the next chapter of their life might look like. The math of personal finance is important, but the psychology of it, that's where wealth is actually built.
Because money will always follow the person who isn't afraid of losing it anymore. If this video made you think about your own relationship with debt and financial security, share it with someone who's grinding through their mortgage right now. Sometimes the most powerful thing you can hear is that the finish line is closer than it looks, and that everything waiting on the other side of it is worth it.